This is T4 Lesson 4. Today we learn why an asset like Bitcoin can trade at different prices for now versus the future. What you'll learn: 1. The gap between spot and futures prices is telling you something. 2. Futures have an expiry, and there's a way to manage that. 3. Some people earn returns by trading that gap. Watch the Bitcoin daily chart on screen and follow along as we see how these ideas work in practice. Got a question? Drop it in the comments. Think about the Bitcoin on your screen. Spot means I buy it today and own it now. Futures means I agree to buy it in March, a forward promise. In a textbook, the same good should have the same price, right? It's like a gallon of milk at a gas station store versus the same gallon at a supermarket. When the prices diverge, that gap is a signal of market psychology. We call that gap the basis. Simply, spot price minus futures price equals basis. Example: Bitcoin spot at $100,000 and the 1-month future at $98,000 means a basis of plus $2,000. A large positive basis means buyers are crowding into own it right now. A psychology signal, the same way a hot S&P 500 name can gap up on Fed Day when everyone wants exposure immediately. A positive basis means spot is more expensive than futures. Historically, bull markets tend to see basis widen. Why? People want Bitcoin in their hands today, so spot gets bid up, like a designer handbag jumping above list price when demand is hot. That basis size reflects market mood, is a well-known observation. It doesn't always lead to violent moves, and it can differ by exchange and by hour. The key: basis is a signal, not a surefire forecast. Compare recent price action on this chart with how basis has been shifting. Unlike spot, futures have an expiry. A March contract is forced to settle at the end of March. Think of it like a 12-month apartment lease with a hard end date. Want to keep the March futures exposure? Before March ends, you switch into the April contract. That's called a rollover. Specifically, you sell March and immediately buy April. Timing matters. Liquidity thins in the last few days before expiry, so pros usually start rolling about 2 weeks out. But there's a cost. We'll cover that next. Here's the important part. Farther dated futures are often more expensive. Example: if Bitcoin spot is to 100,000, March futures might be to the 101,000 and April to the 102,000. March cheaper than April. Why? If you buy spot today and hold it into the future, you pay interest on the capital, exchange fees, and similar carry costs. Those costs get priced into the futures curve in advance, like baking next month's warehouse storage bill into the forward price of coffee beans before they even ship. That structure is called Contango. Every time you roll, you pay that cost, and it can add up to roughly 1 to 2% to a month. Now we use that cost gap. The strategy is called arbitrage. In a Contango structure, a way to aim for return with relatively little directional risk. Concretely: 1. Buy spot Bitcoin long. 2. At the same time sell the April futures short. By April, the two prices converge, so you can capture that gap, say about 2,000 in our example. In practice, you still face fees, funding interest, and liquidity differences across venues. So the Contango gap usually needs to be above about 1.5% per month before you clear break-even and keep a profit. Plenty of hedge funds and trading firms automate this. The edge per trade is thin, so scale has to be large for it to matter. Same logic you'd see in S&P 500 basis trades after a Fed decision. Let's recap. 1. The spot futures price gap, the basis, is a signal of market psychology. 2. Futures expire, and staying in the position means rolling to the next month, and that roll has a cost. 3. Knowing and using that cost gap is the arbitrage strategy. In Lesson 5, we'll apply these ideas to building a portfolio. If today's class helped, please subscribe and hit like. This lecture is for education only, not investment advice. You're responsible for every trade you make.